Hello, everyone, and welcome to the Your Mark on the World show. I'm your host, Devin Thorpe. I'm a Forbes contributor covering social entrepreneurship and impact investing. And today we're having a wonderful discussion with three of the world's greatest experts on crowdfunding. We have with us today Richard Swart, who had a long tenure at Berkeley covering these things and is now with Next Gen Crowdfunding. We also have with us Sam Guzik of Guzik & Associates and Sarah Hanks, the CEO of CrowdCheck. Sam, Sarah, Richard, welcome to the show.
Thank you.
Thank you, Devin.
You all joined me last year for a discussion about Regulation A and the rules that were issued last spring. That was kind of an exciting time in the crowdfunding world. Our discussion was so popular. In fact, it was one of the 5 most popular interviews I did last year among 150. So I was excited to get you back to reprise the team here to discuss the new crowdfunding regulations that were issued last fall and that will become effective in May. Richard, I wonder if maybe you would just take a moment and give us an overview of the history of these crowdfunding regulations to set the table for our discussion.
I will try to make it brief and less painful than usual, Devin. Regulation Crowdfunding was approved by the SEC in October last year. It goes live the middle of May this year. It comes out of Title III of the Jobs Act, which was passed in, I believe, April 2012. So it's been about a 3.5, almost 4-year process of waiting for the Securities and Exchange Commission to evaluate how equity crowdfunding was working in other parts of the market, the angel investing and Title II parts of the market. They finally, I think, were comfortable enough and had enough pressure from the industry that they passed Regulation Crowdfunding. So it's been a long process, and we're all excited that it's finally here.
So, Sam, I wonder if you would just take a minute and highlight the distinction between rewards crowdfunding, like we do on Kickstarter, and what this regulation covers.
Well, actually, there's a major difference in a couple of respects. One is with rewards-based. With equity crowdfunding, you're selling an interest in your business, whether it's common stock, whether it's preferred stock, whether it's even a note. It's selling equity, and that brings you under the coverage of the federal securities laws. We now have a specific exemption which addresses that Title III of the Jobs Act. And so it's a very heavy, Title III is very detailed in its regulations. There's a lot of detail to comply with. There's a lot of homework that anyone considering that needs to do. Rewards-based crowdfunding, on the other hand, is essentially, for the most part, it's unregulated. It certainly doesn't trigger federal or state securities laws. So you have a lot more leeway in terms of what you can do. You don't need to make filings with the SEC. You're not subject to the same types of liabilities that you have with Title III crowdfunding in terms of your obligations to disclose information, to do that truthfully and accurately. So there's a lot more homework to be done for somebody looking at equity crowdfunding.
That's a great point. Now, Sarah, your company helps people organize their documents for an offering, and so you've offered some tips for the article I wrote about this interview on Forbes and I want to just talk about the first tip you gave us, and that tip was that to remember that you're not allowed to, let's see, you're limited in what you can say outside of the platform. Tell us a little bit about those limitations, because I think this is an important nuance. It's even a little different than how a Reg A offering or a 506C offering might work.
Yeah, it's completely different from Regulation A and 506C. And so entrepreneurs need to really know what rules that they're relying on and why these rules are different from the other ones, because they're going to look at other campaigns and go, hey, they're putting all sorts of information out over Twitter and over all of the different investment platforms, and that's not going to work for Regulation CF. So here's the rule. Regulation CF says all of the information, as Sam said, there's a load of information that has to be disclosed by issuers, that's the companies who are raising the funds. All of that information has to be in one place, which is on the intermediary, the crowdfunding portal or the broker-dealer who is the investment platform. And you can only use only one intermediary at a time. All of that information has got to be there, and so that's where the investors will go in order to learn about the company and make an informed investment decision, which is what we want. We want them to understand what they're investing in. Outside of the intermediary, the funding portal or the broker-dealer, only very, very limited communications, and that's what we call tombstone information. It doesn't mean that you can't use different media. You could use Twitter and Facebook and Instagram and all of the other social media. You could put this information on a sandwich board and wander down the street, but it's very limited information. It's what is the company, what does it do, the fact it's doing an offering, go here to the intermediary to learn more. That's all you're going to be able to say. What you're offering and who you are and where to go for more information. So all of the types of solicitation that companies are doing in Reg A offerings or 506C offerings can't do that. Limited information, unlimited ways of sending that information out, because what you're wanting is everybody goes to one place to learn about what the company is offering.
So this is a huge innovation in securities and entrepreneurship. It really changes the paradigm, and we've been talking about this now for 4 years since the Jobs Act was being discussed. But we're really at a momentous, exciting time in history as this comes to reality here in the next 90 days or so. Sam, you talked about the need to look before you leap as you were thinking about and preparing for this discussion, and that was one of the tips you gave me. Tell us a little bit about what you mean by look before you leap.
Well, I mean, there's, as I mentioned before, there's a great deal of details in here. This is not like rewards-based crowdfunding. Number one, if you're doing a rewards-based program, you're pretty wide open in terms of the type of solicitation that you can bring. The other point, which I mentioned earlier, is one of liability. When you bring investors into your company, then you become subject to the federal securities laws when you're selling that security, and that brings with it liability. And the way this statute works is basically a negligence standard. So if you should have known something was wrong, but you didn't know it was wrong, then you could wind up in a situation where your investors have the right to get their money back. Rewards-based crowdfunding, it's highly unlikely, in the absence of just knowingly false promises, that you're going to get involved in any kind of lawyers chasing you to get your money back, just like selling any other product. So that's a big difference. The other thing is you need to understand you're selling a security. What type of security are you going to be selling? Is it going to be common stock? Is it going to be preferred stock? Is it going to just simply be a note that you're going to pay back at some point in time in the future? Will the note be convertible into stock? These are the kinds of things that you don't need to address in rewards-based crowdfunding, which frankly I think is a lot more fun for the company. You know, in terms of rewards and that sort of things, it's a much simpler process.
Sure. Now, Richard, you pointed out that you think Congress, in writing the Jobs Act, made a mistake. The big blunder was not giving crowdfunders an opportunity to test the waters like Congress gave the issuers under Regulation A. Why don't you explain what you mean?
Well, I have to, preface with saying I'm the only person on the panel who's not a securities attorney, but I think that in an ideal universe, the ability of a company to test and gauge the interest of their customers, of their community, and supporting them through an equity raise, through some sort of a testing the waters provision, would have been a really nice innovation. It wasn't discussed, and it's not in the law, so despite my aspiration that that's something Congress might look at in the future, it's not legal currently, and as Sarah noted, you have to be extremely cautious in what you're saying now. The challenge is for small business owners and startups to know exactly what they're allowed to say and in what forums. So the challenge here for many of these companies is they will have to consult an attorney, and they will do a lot of learning and education about how this market works. In rewards-based crowdfunding, you can somewhat wing it. Unfortunately, a lot of people do wing it and have poor results, but it doesn't take the level of depth and compliance and preparation of this market will take. And I think having some ability to test and gauge before you commit those resources and legal fees and expenses would have been a nice solution.
Would have been, but it isn't the case. Isn't the case.
Not the case, and aspirations don't matter. Comply with the laws it's written.
Yeah. So, Sarah, I want to come back to you for just a minute and I talk a little bit about your observation that everything, and there's a lot to put on the intermediary's website, but everything must go there. It's kind of an extension of your earlier thought, but explain a little bit about what's required to be disclosed and why you can't put that information elsewhere.
Okay, so starting with the actual rules, the requirement is that before, as Richard said, there's no way of testing the waters to find out if anybody might be interested if you were to do this offering. You've got to jump in, and you can't start doing any kind of offering, not even the go to this site if you want to learn more type of offering. You can't do any of that until you've filed with the SEC. And what you file with the SEC is the stuff that Sam had mentioned earlier. There's information about the company, its financial statements, a discussion of its performance, a discussion of what the securities rights are and what other people's securities rights are, the ownership of the company. There's a whole bunch of information there that has to go to two places, to the SEC and onto the platform. And everything that's on the platform has to get filed with the SEC, and everything that's been filed with the SEC must be available on the platform. So anyone who is doing a Regulation CF offering is going to have to work very closely with the platform, the intermediary, who's going to be a broker-dealer or a crowdfunding portal, to make sure that they understand what is required to be put onto the platform and how it should be presented. Because different platforms are going to have different rules about how you present it and where it's shown, and comply with their rules, get all of that ready, and then simultaneously open up the offering to the investors and to the SEC. So everything happens at the same time. And the rules behind, the reason behind, again, it's a really good reason, which is Congress and the SEC want everybody to be able to make an informed investment decision and everybody to get the same access. And that's why everything has to be in the same place.
So, Sarah, that everything would not only consist of the information that you might put into a document, but it might also include videos,
Yep.
might include PowerPoint presentations, etc., right?
Yeah, the everything is everything. And so if you have a video, and I think a lot of folks are going to do videos because that's what we do in the online offering space, the transcript of that video got to go to the SEC, and you can't have the video viewed by anybody until the transcript of it has been filed with the SEC. So there's some coordination that's going to happen here.
Wow, very, very interesting. Now, Sam, you also gave us a couple of other tips. You mentioned that the devil is in the details. What were you thinking about when you suggested that the devil is in the details?
Well, I tried to cover that a little bit before, but let me just let me cover some other points in a little more detail.
Okay.
Let's look at the company first of all that goes out and actually succeeds in doing an equity crowdfunding raise. One of the things that they're going to have to consider, and I don't want to get too technical here, but basically once they complete that, they're going to have to make available to their investors annual reports with disclosure that's not going to be too dissimilar from what they need to file with the SEC for the original offering, and that's essentially an ongoing obligation as long as they have these crowdfunded securities outstanding. The other thing I think it's important to consider, and I touched on this, mentioned in your article, is you have to understand who the crowd is for an equity crowdfunding offering. If it's rewards-based, let's say you have a great product, typically a company is going to have the product, they can see it, There's a video that shows how it operates. They need the money to manufacture it. And so you can assess, is it something I like? Is it a good price? When you're investing in equity crowdfunding, you're investing in, you're really looking for some, even though you want to support the company, you're looking for an investment. Is this a good return? And so then you start looking at long-term things like, how can I really rely on this management long-term? Who are they? Are the terms of the investment fair? Am I going to, if the company succeeds, am I going to make a profit and how much? And then also, of course, how do I eventually liquidate my investment? Where can I sell this security anywhere? So there's a lot of more longer-term things that one needs to focus on as a crowdfunding investor in the equity offering, and so it's important for a company to understand that. Two very different types of campaigns from a marketing point of view, leaving apart all the legalities and the specific disclosures that you have to make.
It is interesting. A great point. Richard, you also made an interesting observation. You suggested that the biggest misconception people have is that crowdfunding will replace venture capital. So you don't see that. Tell us a little bit about what you see and why you see it that way.
Well, several reasons. First of all, the amount of the capital you can raise. You're capped at $1 million per calendar year for a company, and given the cost of the capital raise and the amount of effort that's required, it's not going to be a trivial exercise. So I really don't see companies doing this every single year. I think it's going to be more of a one-time event for the vast majority of companies that do choose to use regulation crowdfunding. Secondly, if you're really a high-capacity, high-growth tech startup, and there's a very narrow set of companies that venture capitalists care about, basically huge markets and a relatively low cost of scale. So the next unit of production, whether it's a piece of software or a piece of technology, is relatively inexpensive. You're allowed to grab a huge market share quickly. That only defines a very, very small slice of all companies that ever are created. So I think that this is probably going to be something that will supplement or exist alongside seed investing, angel capital, friends and family, your rich uncle. This is just going to be a new way of accessing capital, but primarily, I believe, from existing networks of relationships. And what we've seen in looking at some of the data is that equity crowdfunding oftentimes is used to close a capital raise. So you have a couple people that commit $100,000 checks or $250,000 checks, but I think one of the misconceptions is that this is going to be used as a way of initiating a capital raise rather than closing a capital raise. And I think just the cost structure is going to turn this more to local businesses that may be saying, I can't get a loan from a bank, or I'd love to be able to sell part of my company to my customers, or people that want to support, maybe it's a food-based business or a local business in their community. It's going to be more of a small business financing option than something used by 500 startups or really high-tech companies who will probably still choose to use traditional venture capital since they have really rapid capital needs that, if they do achieve scale, come fairly quickly.
Yeah, interesting. Sarah, I want to ask each of you. We've got just a few minutes left. I want to ask each of you for one final tip. We'll start with you, Sarah, and then Sam and Richard. I'll ask you to bat cleanup. But one final tip you'd offer entrepreneurs who are looking to do a crowdfunding raise. Sarah?
Get all of your documents together ahead of time and decide whether or not you want to make all of the things public that you're going to have to make public, because you're going to have to put some of your dirty washing out there. How much are you paying yourself? It's got to be disclosed. Do you have any related party transactions? That is a sweetheart deal with somebody else who might be related to you. So think about what the disclosure is going to include before you start thinking about doing this.
Great. Sam?
Yeah, I think the best advice I could give anyone looking at this area is to understand what your options are. And there are a number of options, and they may or may not be a good fit. And even if they seem like a fit, each one has pluses and minuses. We've talked about rewards-based crowdfunding versus equity crowdfunding for Title III. But there are other options which we talked about. I know we had this interview a while ago with Regulation A+, which is a mini IPO. That's generally more suited to companies that are further developed than a startup, although there are limited exceptions. But more importantly, I think companies need to look at what's in Title II of the Jobs Act, which allows companies with much fewer restrictions and much more flexibility to widely solicit their offering. The one hang-up, of course, is you can't have any investors that are non-accredited investors. So you can solicit to the world, but your investors need to be accredited investors. But it is an advantage. There's no specific form of disclosure. There are no disclosure filings with the SEC. There are no limits on how much you can raise. And there are other advantages as well. But on the other hand, there are advantages to a what I call a pure type crowdfunding offering, whether it's equity or rewards based. So I think it's important to get that advice at the outset, to know what your options are, and then to make your decision as to how to go forward.
Great tip, Sam. Thank you. Richard, what's your final tip?
If you'll excuse the blatant pitch, I'm going to tell you to go to Next Generation Crowdfunding. The reason is I was convinced to leave the university because of our founder's passion for providing education. So we are not a crowdfunding platform. We're an educational company that provides free information for investors and issuers on how to take advantage of these rules. We have over 90 different videos up there right now talking about the nuances. I mean, Sam said the devil's in the details. There's a huge amount of learning to be done. So do your homework, figure out where you are, what your capital alternatives are, do a lot of digging, and my joke is always CYA, consult your attorney before you do anything.
Fantastic. Now, before we wrap up, Sarah, Sam, and Richard, maybe in that order again, let me just invite you to tell everyone how they can connect with you and what you do, and why they should connect with you, and what you do at with your company for people who are in the looking to do crowdfunding. Sarah?
Okay, well, CrowdCheck can do one-stop shopping for people raising capital through Regulation CF or for the intermediaries. We have fixed prices for doing the disclosure, doing the filing, and we also do due diligence. And you can get in touch with us, Sarah at crowdcheck.com.
Fantastic. Sam?
Yes, well, I've been doing this for a long time, representing mostly companies, issuers, looking for capital, usually a little past the startup phase, companies that are emerging that want to go public someday or about to go public. So that's what I've been doing, and I recommend that anyone looking at this area engage an attorney who's not only corporate securities, which I am, but also somebody who's really spent a lot of time and understands not just the law, but the environment and how to navigate this. Anyone who wants to contact me can do so on my website through my contact form, which is guziclaw.com, or my email address, sguzic@guziclaw.com. And I'd be happy to, and I generally do speak with anyone who just wants some general information and guidance, so happy to do that.
Thanks, Sam. Richard?
Very briefly, in my Twitter handles is Richard Swart, that's S-W-A-R-T. I'm fairly active on Twitter. I also have Richard Swart, PhD, on LinkedIn. All my research and publications and articles that I've done on the industry are available on my LinkedIn profile, so that's probably the simplest thing, is to just reach out to me through LinkedIn and I can connect with you. I don't do consulting. I don't help people run projects. I don't help people do campaigns. My role has basically been to help provide education and research and analysis for the industry, and I'm now doing that under Next Gen Crowdfunding. So check us out. It says NextGen CF on Twitter or nextgenerationcrowdfunding.com.
Fantastic. Well, Sarah, Sam, Richard, thank you all for taking the time to be with us today, and wish you every success in helping to roll people out in the Regulation CF world this May.
Thanks.
Thank you, Devin. It's always a pleasure.
All righty. Let's do some good.